Hey folks, welcome to a very special 3 at 3. Not just special because he is here, Pete Najarian, but also because of what's going on in the markets. So we figured we better break some things down for you guys because you've probably been listening to a bunch of macro BS and you don't know what to make of that. Well, does that mean I should buy it or should I sell it? What's going on here? Why are these guys talking about how thick Alan Greenspan's briefcase is? So, despite the fact that that was a little levity, we're mainly going to be serious here, folks, because this is some pretty serious stuff. We're talking about billions and billions of dollars being swallowed up and just destroyed. And we're not saying it's a contagion that's going to take everybody down like the great financial crisis had the potential to do that, with only leaving perhaps a couple banks standing. And by the time all their contraparties were down as well, there might have been nobody standing. We're not saying it's like that, but we are saying that Pete and I, this is not our first rodeo. Right. We have been through, I was through 87. I was through also the great financial crisis with Pete when he was our head trader. So Pete, maybe let's remind people what happened back then, because there were a lot of smart people that were buying puts very aggressively. We are seeing some of that same stuff play out right now.
Yeah, you're exactly right, John. And really, when you go back to it, everybody always goes to which one? Lehman. And you and I always say, no, you guys are all wrong. You don't understand anything clearly, because if you go back to Bear Stearns and you go back to March 20th, and you see all of the volume that was happening within this marketplace, and they were buying puts, John, they were at the 30 strike. Now, why do you buy a March 30 put when the stock's trading about $68 a share and everybody's convinced that, hey, these guys are fine. The CEO said they're fine. Everybody on TV says they're fine. Don't worry about it. Well, it is something to worry about. And suddenly, what do we find out? Well, before we can blink, we see the stock trading, what, under 5? and those options that they were buying, those tens of thousands of options that they were buying, go from 30 cents up to nearly $3. Or $30 rather. So, there's a lot to it, John. There really is. And then, of course, there was Lehman and all the rest as we led into that. But it really did start with Bear Stearns. And it was a put that you just scratched your head. I got one example today, John. I'll even just give you right now. So, all right, looking at Blackstone, for instance, right? And we've had quite a bit of different put buying that we have seen in just about every financial you can imagine today. Well, why would you buy when the stock is trading $82? Why are you buying the 50 strike puts that are in March that only have another week to go? I just put that out there, not saying anything about the correlation, but it is a bit of a correlation, a little bit odd. And we will see. Maybe it's nothing. Maybe it's just somebody just taking a shot. But I will say this, and it's not nearly the same kind of volume, so I don't want to, put that out there like it's the same type of trade. But it's pretty far out of the money for a 1 week out option, right? So it does make you scratch your head just a little bit when you see some of this. And you and I, over the last, I guess call it week, give or take, we have seen an incredible amount of option flow on the put side, looking for more downside, whether it's in indexes or individual names.
Yeah, and those people have been right, Pete. I mean, we'll show you examples in a bit, folks, but we just wanted to give you a little context about, again, this ain't our first rodeo. We've seen this before. Some of the people that you watch and probably laugh at on TV have never seen it. And or they watched it and they did laugh at it because they didn't know how serious it was. A run on a bank, I mean, all you got to do, Pete, we didn't want to get a strike from YouTube or anybody, or I would have pulled up It's a Wonderful Life. And when, you know, when the bank is failing and everybody's waiting in line to get their money out of the bank, well, there's never enough money in any bank for you to get all your money out of the bank. And so, you know, the hero was more or less saying, well, your money's not here. It's in his house. It's in her business. You know, we lend it out so that you can build the community and this and that, right? Well, and then you listen for Potter's not selling, he's buying. Well, there have been Potters. There, for instance, Dave Tepper, he was a Potter. Dave Tepper, in the great financial crisis, after it hit in September, he and his team broke down trades. I'll talk about it because I just talked with Larry McDonald, one of the experts. He's got one of the top financial books of all time. It's called The Colossal Failure of Common Sense. But when you have a run on a bank, you can take a bank down like that. And that's what's happening. Now, obviously, today we had the Fed step in and say, you know, hey, we got to take over Silicon Valley Bank Corp. They don't have enough assets on hand or, you know, cash on hand to meet the demand that is coming in. So we halted the stock. Well, that means the stock is done. When they halted that bad boy, the stock is done. It's not like they're going to reemerge and everything's hunky-dory. They will get bought by somebody. So this is just like what happened in the great financial crisis as far as you forced a marriage. I mean, Jamie Dimon didn't go in there saying, yeah, I really want Bear Stearns and I'll pay $2 for it. Like Pete said, that was a $68 stock a week before that, or even just days before that. And all of a sudden he pays $2. And then he, out of the goodness of Jamie's heart, he ended up paying $10 for it. But there are going to be forced marriages, folks. And that's one of the issues that Pete and I wanted to bring up to you guys is you don't have to be the first mover on these things. Again, David Tepper, as you'll hear from our interview with Larry McDonald, Larry describes David Tepper as quick as he could with his team, breaking down which banks to buy, which ones are going to be bought, which ones are going to be put to death, because some of these will die and they will never be there again. Now, if you're a depositor in those banks, you're good up to $250,000 in FDIC insurance. So, and of course, in the great financial crisis, Pete, they extended that up to an even higher level. But we're not trying to create runs on the bank at all. That's not our purpose. We're telling you, if you have less than 250,000 in that bank and you're trying to get money out of there, don't panic. You're fine. You're covered. And this is not crypto. This is fiat. This is US dollars, and it's fully insured by the Federal Deposit Insurance Corporation. So again, while some people are running around with, if I had hair, their hair on fire, we're saying be logical, be smart, be patient, because those will reward you. You will be the ones then finding these great assets that you can perhaps buy for pennies on the dollar. So if you don't mind, Pete, maybe give us one more example of General Motors, which was a $35 stock when they started buying puts in the great financial crisis.
Yeah, you know, there's quite a few different examples out there, John, where we've seen just some of the what looks like outrageous pricing that people would actually go to as far as they would to try to get themselves into a levered position where they can. Obviously, the options market allows you to be able to do that and find themselves into what potentially could be something really, really big. And you know, there's a lot of different examples of that, John. The one thing that I would just say is, you know, like you're saying, John, this is not necessarily a situation, anything close to what we'd seen in the financial crisis. It's more of, hey, look, there's a lot of different issues going on right now. There are things that are sort of stacking up, so to speak. And because of that, it makes sense that people are at least either buying protection or expecting something to get a little bit worse than it is right now. So that's why I think we are seeing, option paper to the put side in quite a few different financials, some of the different ETFs that are out there, and people are sort of positioning, trying to get themselves into a spot where at least they can feel a little bit of comfort. You and I have always used to say this, John, about puts, and puts are essentially your insurance, right? You buy insurance on your vehicle, you buy it on your house. Why wouldn't you buy it on your positions in the market? And I think that's something that everybody kind of loses track of at times. It's not always something that's done to say, you know what, this stock is absolutely cooked. That's not always the reason. Sometimes you just want to have some protection out there, like an insurance policy, so that you can go to sleep at night and be able to sleep. And, I think that's a little bit of what we're seeing as well, John. I think that we've seen a lot of option paper. Obviously, we've seen this flow. We saw a couple of days this week where we've actually been down significantly, including today, where we were down over 400 points, but we've rallied back. And then we went down again and we've rallied back. So there is going to be some volatility. And I would warn people a little bit, with that volatility, that means that some of these options start to get a little bit higher priced than you're probably expecting, because it wasn't too many days ago we were trading 18, 17 on the VIX, and then we started to push up towards the 19s. Last I looked today, John, I think we were in the 28s. So the volatility index has spiked up. So expect that to be there as well. And don't forget about the VXN, the volatility of the NASDAQ as well. That is something I think that you've got to keep in the back of your mind also is, with the kind of market moves that we are seeing right now, you are seeing volatility go with it, which makes total sense, because we are moving at a much different pace than we were just a week or so ago, when the volatilities were far different than they are right now.
Absolutely. And that's great insight there, Pete. Folks, we want to share with you a couple of trades that set up for us and how they worked out. This is not to show you, oh, we're always right, because nobody's always right. But we're going to show you these because they, I think, emphasize the point that we're making about which stocks we're seeing this unusual activity. So you guys know that Pete and I do shows together. We're going to be doing a streamed show with a major network very soon. And you guys are going to, I think, be very impressed and hopefully love it. But unusual activity is a phrase that we coined. We coined unusual option activity, unusual activity. We also came up with a computer program, an algorithm called the Heat Seeker, that we can find unusual call buying or unusual put buying, large blocks of stuff that's being accumulated. Here's an example. SBNY, Signature Bank, okay? Look what they were doing 2 days ago. On the 8th of March, this is a Wednesday trade, folks. Today's Friday, the 10th. Okay, 2 days ago, they were buying the April 80 puts. The stock was 104 when they were buying those. So that's $24 out of the money. Eerily similar to what Pete was talking about in Bear Stearns when they were buying with the stock at 68, the 50 puts or something. It's like, who's going to buy that? The stock has to fall by an awful lot for you to get paid on that. Yeah, if it makes a quick dip, you could see these puts that were purchased, let me see, for $2.47. You could see those puts pop to $3 or $3.50 if the stock made a lurch towards 98 very quickly, but it didn't. This is what it did. Today it's down $22 and it's trading 68.93. Those puts are $11 in the money, folks. $11, that's the intrinsic. Intrinsic means in the money. The intrinsic value, the right to sell it at 80 when it's trading 69, well, that's worth $11 plus some premium. So whoever was in these didn't just make 5 times their money. They're probably looking at 700% on this trade. And they have the equivalent of 5,000 of these options is the share equivalent, 500,000 shares of stock. So that, my friends, is a big trade. This one, there's those puts, in fact. The puts in SBNY at the 80 put strike in April, $11 is what they were worth, right? Because, again, it's trading 69. 80 minus 69 is 11. But look where they're trading. $23, almost $24. That's that extrinsic value. The extra premium, because these don't expire till April. They've got 6 weeks. Yep. So nobody in there wanted to sell them at 11. They're selling them at 23. So in other words, if you bought them for 247, you've got about 1,000% return on your capital, not 700%, 1,000%. Another example. This is the ProShares Bitcoin ETF, Pete. It's not a direct Bitcoin correlated, but it obviously is set up. They call it the ProShares Bitcoin Strategy ETF, whatever that means. But it was 1363 3 days ago on the 7th, Tuesday, and there it is, trading down hard today again, and these puts being worth, instead of 20 cents where people were getting in on Tuesday, $1.27, 600% on your money. This one today, the KRE, for those of you who tuned in for 3 at 3, you could kind of put this on there and say, oh, there's your 3 at 3. Yeah, these were both today. Pete and I were in these. They bought 22,000 of the April 50 puts, and then they sold the same number, 22,117 of the 45 puts. I mean, this is somebody who was right, because look, they were liquidating the 52 puts, rolling down to the 50s, and then selling the 45s against it. That's what's known as a put spread, the differential between 50 and 45. And then the top one on the page, then they said, you know what? We're going to buy 10,000 of these March 47 puts. This is the regional banking index. It was almost $52 when they did that. Where's the regional banking index now? We'll see if it holds 49, because it's getting hammered. It's down 7%. I mean, regional banks getting killed. Again, wait till you see and listen to the interview that we did with Larry McDonald, because Larry, my God, he just lays out exactly how he thinks this is going to play out, Pete. Here's the top holdings of the KRE, the Regional Banking Index. You know which one has the most sway in there and is halted at $40 a share? Silicon Valley Bancorp, SIVB. Look at that, 2.35% of the index. So when this opens, and SIVB is zero, well, that means that this is going to take another hit. So that's why they were buying these puts. And they're already right by almost $3. It was almost 52. Now it's 49. So these, again, we're looking for those people who are right time and time again. That's the stock 2 days ago, folks. It's today to 2 days ago. As it says there, trading halted at 39.40, was down 63% on the day. 2 days ago, it was $267 a share. This bank went from $267 a share to zero in 2 days. Again, we're not trying to scare you by saying that. If you have deposits in SIVB, in Silicon Valley Bank, we are not making fun of it. We are not laughing, ho, we've got puts, we're the smart guys. No, but we are saying if you've got less than 250,000 in there, you don't need to worry. Your money is safe. The full faith and credit of the United States FDIC is behind you. So don't panic. Take a deep breath, maybe pick a couple stocks, not this one, but pick a couple stocks that you might think about buying and things like that, because you have the same amount of money as yesterday unless you own the stock. Those people have to worry. Now, one thing I'll throw out to you, Pete, that again, you ain't going to hear this on CNBC. You're not going to hear it on any financial network, but you're going to hear it right here. And that is, let's say that you're a company in Silicon Valley. There's a lot of them out there, right? Well, if you say, yeah, in our treasury, we've got $72 million. I spoke to one of these companies today. So let's say you have, does that mean it's in a vault in your basement of your office? No, It means it's in a bank somewhere and hopefully spread between several banks, but there ain't no bank that's guaranteeing 72 mil. Just doesn't happen. Now, does that mean that they're going to lose all their money? That, like, for instance, I'll pick Elon Musk, richest guy in the world. Let's say that Twitter had 72 million. It's not Elon, but let's say Twitter had 72 million in the bank. They're going to be in a squeeze for a while because it's going to take a while for them to get what what is theirs out of that bank. So this will create, Pete, I think, a number of opportunities in the market because people will be rumoring that, oh, did you hear Stripe? They don't have any money. All of their money that was in the bank that the VCs gave them, it's gone. It wasn't stolen by Sam Bankman-Fried, but there was a run on the bank. They shut it down. When do you get your money? How do you make payroll? All those kinds of things. These issues will come up. Trust me. And like I say, you're not hearing that from anybody else, but you heard it right here.
Yeah, it's a wild one, John. I mean, it's an unbelievable feeling that I'm sure many people are squirming around and for the right reasons. They're very, very nervous. And hopefully a lot of those folks understand what you're talking about when you say up to 250,000. That part's at least, backed up. But there are people with more than that maybe in there as well. And maybe there is a little bit of nervousness. I would say that, for a while now, we've been talking about not just the debt of the United States, but the debt of a lot of the folks in the United States when it comes to credit card debt and housing debt and all the rest of those things, which also is in that $16 trillion world. So, I think it's something that hopefully people have listened to some of those cries out that we've put out there that say, hey, man, this is something to keep an eye on because this is something that should be a little bit of a concern for people, right? And hopefully people have heeded that advice. I'm not sure that they have, but when you look at the option activity that we've seen this week, including today, it's an overwhelming amount of puts that have been acquired, whether it's in a U.S. bank or a Citi or a Blackstone or an Ally or you name it. There has been an incredible amount of put activity, and we've been talking about it all week, but it continues today. And I'm sure that those folks that listen to the 3 at 3 are probably hearing some of that as well.
Yep. Well, as you know, Pete, that Ally Financial, that's a company that lends to all manner of beasts. They have auto loans, they have home loans, they have just about everything. And they were buying with the stock at 28.5 yesterday, Pete. They were buying the 27 puts. Today, stock traded to 25. The numbers don't sound as big, but the percentages are as big, folks, because you took a $27 put and it was worth $2 intrinsically, again, in the money, and then some premium on top of that as it fell all the way down to 25 this morning. So you should have made, if you were in that trade, a good amount of money. By the way, if you want to trade momentum, we'd invite you to join us. We have our roundtable Tuesday next week, March 14th, 4 p.m. Eastern time. You can just go to that's www.marketrebellion.com/register. It is completely free. We don't take a credit card and try to milk some extra money out of you. We just do this and tell you how we're trading and why we're trading that way. And then you can judge whether or not A, you'd like to be a subscriber, or B, if you'd like to learn to trade the way we trade and so forth. It's all there. www.marketrebellion.com/register. Check it out, my friends. And Pete and I appreciate all your support. We'll be back with the Rebel's Edge Monday, 1 p.m. Eastern time.